Fusion Markets.
Hello everyone, and welcome to this Fusion Markets video on the basics of Forex trading. So let's start with currency pairs. And there are 7 major currency pairs, which all involve currencies paired with the US dollar. And the US dollar is also known as the greenback in the trading world. So these major currency pairs are the euro against the US dollar, the Great British Pound against the US dollar, the Australian dollar against the US dollar, the New Zealand dollar against the US dollar, the US dollar against the Canadian dollar, the US dollar against the Japanese yen, and finally the US dollar against the Swiss franc. And each of those has their own name in the trading world. Just like the US dollar can be known as the greenback, these 7 major currency pairs also have alternative names. So the euro against the US dollar can sometimes just be called euro or sometimes be called fibre. The Great British Pound against the US dollar is also known as cable. The Australian dollar against the US dollar, also known as Aussie. The New Zealand dollar against the US dollar, also known as Kiwi. The US dollar against the Canadian dollar, sometimes just called CAD, or occasionally it can be called the loonie. US dollar against the Japanese yen, sometimes just simply called yen, or sometimes called ninja. And the US dollar against the Swiss franc often can be known just as Swissy. So there are other currency pairs that are paired with the US dollar, but the above are what's called the major currency pairs. There are other currency pairs as well called cross pairs, and those are where currencies are not paired with the US dollar. These are the ones here which you will predominantly be trading along with the majors. So, Aussie against the Canadian dollar, Australian dollar against the Swiss franc, etc., euro against the Swiss franc, and so on and so on. So you've probably heard of a pip or pips, but what actually is a pip? Well, it's the 4th decimal place of the exchange rate for a currency pair. So in this example here, 1.15382, the 4th decimal place, 1, 2, 3, 4, is this 8 here. So this means 8 pips. The 5th decimal place, often omitted, and it's a tenth of a pip basically, also called a pipette. So this would actually mean 2/10 of a pip. But like I say, this 5th column often omitted, and you're more likely to see a currency pair stated to 4 decimal places. So let's look into this a little bit further. And for example, let's say we have our exchange rate of 1.1538 and price moved up by 1 pip. The new exchange rate would be 1.1539. If it then moved up another 2 pips, the new exchange rate would be 1.1541. So here we can see our exchange rate here, our original exchange rate. If it moved up by 1 pip, basically we add 1 pip to this 8 here, which gives us 1.1539. If then it moved up another 2 pips, we add 2 to this 39 here, which gives us 1.1541. Let's say the original price moved up 21 pips. Okay, so our original price is 1.1538. If this moved up 21 pips, we'd add 21 to this 38, giving us 1.1559. Now, similarly, the price can move down as well as up. So let's say price moved down 2 pips from our original exchange rate here. If it moved 2 pips down, we'd take 2 from this 8, and that would give us 1.1536. If it then dropped by 32 pips, if the original exchange rate actually dropped by 32 pips, we take 32 from this 38, giving us 1.1506. So we have a question. You want to make 30 pips on the rising price of the Great British Pound against the US dollar. You buy at an exchange rate of 1.2631. What would your target price be? So £1 equals 1.2631 US dollars. That's what that exchange rate means here. And we think price is going to move up, and we wanted to try and capitalize on 30 pips of that potential move to the upside. So what would our target price be? Let's see if I can write this down for you. So we have 1.2, put a point in there, 2631. And we think price is going to move up. So this is an addition. And all we do is we put the 30 pips, because that's what our target pips will be, and we simply add it up. Okay, so we've got 1 plus 0 is 1, 3 plus 3 is 6, and then we just bring the 6 down there, the 2, the decimal point, and the 1. So if we want to make 30 pips on 1.2631, we're looking for price to rise to 1.2661. Okay, so there is an exception to the rule, and that is when we are talking about yen pairs, or pairs with JPY in them. And they are priced to 3 decimal places, okay, i.e. 107.947. And in these cases, the pip is actually the 2nd decimal place. So in our example here, 107.947, it's actually the 4 that's the pip, okay? So it's 107.94, that would mean 94 pips. And again, the last decimal place is the pipette, or the tenth of a pip, so that would actually mean 7/10 of a pip. But that's generally omitted, and you're more likely to see 107.94.7 written as 107.94. Okay, so another question for you, but this time we are going to look at a yen pair and USD, JPY, USD yen, and we want to make 20 pips on the falling price of USD JPY. We sell at an exchange rate of 108.32, so meaning $1 equals 108.32 Japanese yen. And what would our target price be? Okay, so we think price is going to fall. We sell at 108.32. So remember, the pip is the second decimal place, so this is the pips, that means 2 pips. This would mean 32 pips. We think price is going to fall by at least 20 pips, and that's what we want to make out of the market. Because the market is potentially going to fall and we're selling, this is now a subtraction. Okay, if price was going to go up, or if we thought price was going to go up, that would be an addition, but we think price is going to go down, so this is now a subtraction. So 108.32 minus 20 pips, 2 minus 0, 2, 3 minus 2 is 1. Bring our decimal point down, and we've got 108. So our target price would be 108.12. Hopefully you will understand that. So the market, or the Forex market, is open 24 hours a day from 10 p.m. UK time on a Sunday to 10 p.m. UK time on a Friday. Now, in the week, the market does actually close and reopen at 10 p.m. UK each night, where it's literally for a split second, and then that will be the start of the new trading day. So let's say the market opens, Forex market opens at 10 p.m. on Sunday, that will be day 1. 10 p.m. on Monday, that will be the end of the trading day and the start of the new one. So it runs from 10 p.m. to 10 p.m. UK time. Within each trading day, there are 3 trading sessions. We actually start off in the Asian session. So obviously when it's 10 p.m. UK time, it's the morning in the Asian side of the world. So we begin there, and then we move on to the London session. So that's when it's approximately 8 a.m. UK time. The London market kicks in, and then we move on to the New York session, okay, when it's the morning time over in the States. And we generally see the greatest amount of price movement during the London and New York sessions. So especially as the New York session opens and we've got London and New York running concurrently, that is a really busy session, and we can see lots of volatility in the markets. When we are trading, there are 5 possible different order types you can undertake. Okay, they are live or at market, meaning that we are buying or selling at whatever the exchange rate is at that moment in time. We can also have a buy limit or a buy stop, or a sell limit or a sell stop. So I'll go through what those mean now. So I've already explained what live at market is. Okay, that's buying or selling at whatever the price is at that moment in time. Let's say we thought price was going to move up. We can use a buy limit or a buy stop. Buy limit, use if you want to buy at a price that is lower than the current market price. So you want to buy, but you preferably would like to buy at a lower price, a cheaper price if you like, and then we think price is going to move up. Buy stop means if price continues to move up, we want to start buying at a certain price. Sell limit, we think price is going to go down, but we think price is going to go higher first before it goes down, so we're looking to sell at a higher price. And sell stop, we think price is going to go down, and as it moves down, we want to start to enter the market. I'll show you what those mean graphically in this next slide coming up. Okay, so here we have a buy limit and buy stop. We think price is going to move to the upside and we're interested in buying. Let's look at the buy limit first. If you imagine this was our current market price for whatever it is we are trading, we think price is going to move down before it moves up. So basically we're looking to buy here at a cheaper price. This line here is where our buy limit would be, as a for instance. We're hoping price comes down, hits our buy limit price, triggers us into the trade, and then starts to move up. Remember, if this is our entry price, we get triggered in and price continues down, that's when we'd be losing money, but we're hoping price then moves up above our entry price, and that's when we make money or make pips. Buy stop, again, imagine this was our current our current market price, and this would be our buy stop. As momentum moves upwards, we get taken into the trade, assuming that it does what we think it's going to do. So this is just a momentum trade. The buy stop is above the current market price, and we're hoping to get triggered in as price moves to the upside. Sell limit and sell stop. Again, imagine this was our current market price. We think price is going to move up before it then moves down. So our sell limit would be above our current market price. We hope price moves up, triggers us into the trade, and then starts to move down. Because we're selling, if price is below If the market price is below our entry price and we're triggered into the trade, we're making pips. If we get triggered into the trade and price continues to move upwards, we'd actually be giving pips away and losing money there. Sell stop, again, a momentum type of trade. If this is the current market price and we put our sell stop here, we get triggered into the trade as price moves downwards, and we're hoping that price continues to move downwards below our entry price. So as well as your entry price, we also need to work out a few other things. Firstly, stop loss. If your trade moves against you and it starts to move in the opposite direction to which you're trading, then there needs to be a stop loss to tell the broker, okay, at this point I want to close the trade and I'm going to take the loss. Always trade with a stop loss, guys. The difference between the entry price and the stop loss is called our risk pips. For instance, we might be risking 100 pips. That's just an example. Once we know this, we can actually calculate our lot size, depending on how much capital we want to risk, and that tells the broker basically how much per pip we want to be trading with. And lastly, yeah, our take profit level. Obviously, that's the aim of the game, isn't it? To make a profit. So we need to let the broker know if the market moves in the direction we're trading at this point or at this price, this is where we want to take our profit and close the trade and job done. And the difference between our entry price and our target price is called our reward pips. And just a little bit of info, when our reward pips is equal to our risk pips, we call this a 1-to-1 trade. When you are placing a trade, you are probably going to do it on a piece of software called MT4 or MT5. So MT4 means stands for MetaTrader 4. MT5 is the latest updated version of MT4 called MetaTrader 5. And yeah, you'll probably be using one of those two as they are the most popular pieces of trading software. So what I'm going to do is I'm just going to make this box a little bit bigger. I think I have a screenshot of it here. And this is the trade part of MT4. So you have your symbol here, what you are trading. Here it says volume. This is actually where you type in your lot size. Okay, once you've calculated how much money or how much of your capital you want to risk. Here we put our stop loss price and our take profit price. Type. This is your order type. So this is a drop down box, and you can either be live at market or it could be a pending order. Now the pending orders are the buy limit, the buy stop, sell limit, sell stop. So it's a drop down box. If you select the pending order, this will come up, and then again another drop down box, and you can select what type of order it is. And here at what price you want to enter the market. And then you can place the trade once you've got all that information in. This part here, expiry, you don't need to use this, but basically you can put a date and a time in for your trade to expire and close if it doesn't get triggered. Okay, it's not necessary, like I say, that you use this, but some people do. If you are away from your computer, or you're going to be busy and you want the trade to just close itself if it doesn't get triggered by a certain time, then this would be used here. So how do we calculate our lot size? Remember, lot size basically tells the broker how much per pip you are looking to trade. Okay, so if you were in the UK, it might be £2 a pip. If you were in Australia, it could be $2 Australian per pip, etc., etc. But how do we calculate that? Depending on how much of our capital we want to risk. Well, we need to use a trading calculator or pip calculator. Now we do have these on the Fusion website with this link here. What I'll do is I'll just bring over the website for you. Do that now, actually. Okay, so this is the Fusion Markets website, and under trading, we can go to trading calculators, and that brings up this section of the website. Let's say I'm going to go into pip value. Okay, we need to calculate how much per pip we want to be risking, and that will help us work out the appropriate lot size. Okay, so we've got some boxes here, and we're looking to trade Forex. There's some other options here as well, depending on what you're looking to trade. If you want to go into more options other than Forex trading, but as a standard Forex here, the currency pair you're trading, they're all listed here, all those common ones that I've talked about, the majors and the cross pairs. Let's say we wanted the Australian dollar against the US dollar. Account-based currency, depending on where you are in the world. Let's say we're in Australia. And volume in lots. So just as a for instance, I'm just going to put a 1 there. Okay, so 1 lot, and I'm going to press calculate. So if we were trading Australian US dollar with 1 lot in our MT4 or MT5, then that would mean 15.26 Aussie dollars would be traded per pip. Okay, so if price was to move up a pip, we'd make, assuming we were buying, we'd make 15.26 Australian dollars, etc., etc. So if our risk pips was 100, so if remember, risk pips is the difference between our stop loss and entry price. So if we were risking 100 pips, and the pip value is 15.26 Australian dollars, that means that we'd be risking in total 1,526 Australian dollars. Okay, risk pips is 100, meaning 100 pips, and we've got a pip value of 15.26 Aussie dollars per pip. That means that we are in total risking 1,526 Australian dollars. Okay, so obviously from there, we know, is that an acceptable amount of risk, or do we want to risk more or less? Let's say we wanted to risk less, say we wanted to risk, half of that, then you just go into the lot size and put half in, which is half of 1. Again, calculate. Now it's 7.63 Australian dollars per pip. That's what we'd be risking. Again, if it was 100 pip stop loss, we'd be risking 763 Australian dollars, etc., etc. And obviously you can just, alter this depending on how much per pip you're willing to risk. Okay, and this is what you would then put into your MT4 or MT5 or whatever it is you're using to place your trade. A little bit more terminology now, spread and swaps. So firstly, spread. So Forex brokers quote two different prices for the currency pairs, okay? These are the bid price and the ask price. So what is the bid price? Well, that's the price that you can sell the currency pair to the broker. And the ask price is the price that you can buy the currency pair from the broker. Now, the difference between the ask price and the bid price is called the spread and is measured in pips. For example, let's take the pound against the US dollar. And just on a side note, actually, the first currency in a currency pair is known as the base currency, and the second currency in a currency pair is known as the term. Okay, so pound in this case is the base, and USD is the term. We have the bid price and ask price. Bid price is always smaller than the ask price. Okay, bid price here 1.2682, ask price is 1.2683, and the spread is calculated by taking the bid price from the ask price. As we can see here, 1.2683, take away 1.2682. Remember, the fourth decimal place is actually the pip, so it's just like a very, very simple subtraction. That minus that gives us 1, which is 1 pip. Now, this is not a typical price for the spread on pound USD, but take a look at our website, take a look at our spreads, which for pound USD would normally be a lot lower than 1 pip. Compare us against the other brokers, and you'll see that Fusion Markets is extremely competitive. If you're in a trade and it runs from one trading day to the next, then you will have what's called a swap fee applied. Sometimes it's called an overnight fee as well. It can be a debit or a credit on your trade. It just depends on what you are trading and if you're buying or selling. On Wednesdays, you'll have what's called a triple swap. And this just takes into account that the markets are closed on Saturday and Sunday. And on Wednesday, you have a triple swap. So that's perfectly normal. And that's it. That's our special basics Forex video for you from Fusion Markets. If you want to contact us for any reason, then this is our address, our email address, and phone number. You can find this on the website as well, guys. I'll just drag that over for you so you know exactly where you can find it. If you're going to help and contact us, brings up this page. Here's our details. Also, you can just drop us a message in here and we'll get back to you. But from all of us here at Fusion Markets, thank you very, very much for watching today's video and safe trading. Take care.